The real shock didn't come from silver prices exploding, it came from AI leaders quietly admitting scale is colliding with physics, and that changes how this market should be read. When Elon Musk talks about AI needing massive energy and materials, most people hear ambition, but I hear a warning about inputs that don't scale easily. AI models don't run on code alone. They depend on data centers, power grids, cooling systems, and metals, and silver sites inside almost every efficiency-critical component. What caught my attention is that silver demand tied to electronics and energy has kept rising, even while prices lagged and investor interest stayed muted. That disconnect usually doesn't last forever. Historically, when industrial demand grows quietly while prices stay calm, it signals mispricing, not abundance. Recent reports from chip supply chains show silver usage per unit increasing, not decreasing, as efficiency standards tighten rather than relax. In my view, this matters more than speculative narratives, because AI infrastructure is being built regardless of economic cycles or market sentiment. Unlike consumer tech, AI capex doesn't wait for cheap prices. Governments and corporations build first, then worry about costs later. That behavior changes how silver should be viewed. It stops being a trade and starts acting like a bottleneck input with delayed price discovery. What's interesting is how little attention this gets compared to lithium or copper, even though silver plays a critical role in power and precision. Markets tend to focus on what's loud. Silver is quiet, fragmented, and boring, which is exactly why structural shifts often hide there. When Musk and others talk about AI scaling 10x or 100x, they rarely mention materials, but materials are where reality pushes back first. In my view, the $103 signal floating around isn't about a target, it's about stress, where paper pricing struggles to reflect physical constraints. We've seen this before. In energy markets, futures stayed calm long after physical tightness appeared in shipping and storage. Silver shows similar behavior now, with premiums, delivery timelines, and regional pricing diverging subtly from headline prices. That divergence doesn't scream crisis. It whispers imbalance, which is usually more dangerous because it's ignored longer. Another factor people miss is that silver demand is no longer driven mainly by jewelry or coins, but by grids, chips, and automation. Those sectors don't reduce demand easily during downturns. They're tied to long-term policy and infrastructure commitments. In my view, that makes silver less cyclical than most assume, especially as AI becomes embedded in defense, healthcare, and logistics. Statements from data center operators already hint at power and component constraints becoming the real limiting factors. Once constraints appear, procurement behavior changes fast. Buyers lock supply, absorb higher costs, and reduce spot availability. That's when paper markets often lag reality, because contracts price expectations, not urgency. We saw something similar in 2020, when physical metals tightened months before prices reacted meaningfully. Back then, the move surprised many who thought markets were efficient in real time. Efficiency breaks down when systems grow faster than supply chains can adapt, and AI is growing exactly like that. In my view, silver sits uncomfortably close to that pressure point, even if charts don't show it yet. This doesn't mean silver must do anything. It means assumptions about endless availability deserve rethinking. When AI leaders speak about limits, I listen less to the ambition and more to what they're indirectly revealing. They're telling us growth is no longer just software constrained, it's material constrained. And when growth hits material walls, markets tend to reprice quietly first, then suddenly. That's why this story isn't about hype or fear. It's about timing, misalignment, and signals hiding in plain sight. Most people will notice only after prices move. Capital usually notices earlier, through supply behavior. What we're seeing now feels like that early phase where nothing looks broken, but nothing is quite normal either. And historically, that's when the most interesting shifts begin. What surprised me most wasn't a price spike, but how little silver reacted after AI spending forecasts quietly doubled across the US and Asia in the same quarter. When companies like Microsoft and Google talk about multi-year data center buildouts, they're describing physical demand locked in, not optional. In my view, markets still treat AI as a software story, while the real pressure is shifting into power hardware, grids, and conductive materials that don't scale overnight. Silver sits awkwardly in that gap. It's essential, hard to substitute at scale, yet priced like demand is flexible and speculative. What caught my attention is that fabrication timelines for new silver supply stretch far longer than AI deployment timelines now being discussed publicly. You can add servers in months. You can't add mines, refineries, and qualified supply chains on the same schedule. Historically, whenever demand timelines compress faster than supply timelines, pricing models break before headlines change. We saw this with natural gas in Europe, where contracts assumed availability until logistics proved otherwise. In my view, AI is creating a similar setup, but one layer removed, hidden inside components most people never think about. Executives rarely mention silver directly, but they do talk about power density, efficiency losses, and thermal limits, which all quietly point back to materials. Those phrases sound technical, but they're really admissions that software gains are now constrained by hardware realities. Another signal is how aggressively long-term contracts are being discussed behind the scenes, even while spot markets stay calm. When buyers move from spot to long-term locking, it usually means they fear availability more than price. That behavior doesn't show up in charts immediately, but it reshapes future liquidity in subtle ways. In my view, that's why the 103 number keeps circulating, not as a promise, but as a stress marker where current assumptions start failing. People often ask why silver hasn't already moved if this is real, but markets don't price inevitability, they price urgency. Urgency appears only when someone can't get what they need on time, not when analysts predict shortages. Right now, most AI projects are still early enough that delays are manageable, which keeps pressure muted. But timelines are stacking. Multiple hyperscalers are planning overlapping expansion phases, not sequential ones. That overlap is where supply chains get stressed because buffers disappear faster than expected. In my view, that's the future inflection point, not a sudden demand surge, but too many large buyers moving at once. Silver doesn't need to run out for this to matter. It only needs to become harder to source predictably. Once predictability drops, procurement behavior changes faster than prices do. That's when paper markets often lag because they reflect consensus, not friction. We've seen this pattern repeat in shipping, energy, and even labor markets after shocks. The common thread is that systems look stable right up until coordination fails. AI adds a new layer because its growth isn't discretionary anymore, it's strategic. Governments, defense planners, and healthcare systems are all embedding AI regardless of market cycles. That makes the demand profile for its inputs far less elastic than investors expect. In my view, silver is being quietly pulled into that category, even if it hasn't been reclassified mentally yet. Mental models always change slower than physical flows. By the time narratives catch up, the underlying dynamics are usually already locked in. That's why watching what companies build matters more than what markets debate. And right now, they're building systems that assume uninterrupted access to materials that have never faced this kind of synchronized demand. That mismatch is where future tension lives, even if today everything still looks calm. History suggests calm phases like this don't last forever, they just delay recognition. When recognition arrives, it rarely feels gradual. It feels sudden, confusing, and obvious in hindsight. That's the stage this story seems to be moving toward, quietly, without announcements. And in my view, silver sits closer to that turning point than most people realize. What really keeps this under the radar is that silver shortages don't announce themselves with empty shelves. They show up as delays, premiums, and quiet contract renegotiations. In my view, the market is misreading these signals because it's trained to look for price explosions, not subtle changes in access and delivery behavior. Data from industrial suppliers already shows longer lead times for high-purity silver used in electronics, even though headline inventories look stable. That contrast matters. Inventories can exist on paper, while usable material becomes harder to allocate at scale and on predictable schedules. We saw the same dynamic in semiconductors during 2020, when ample supply coexisted with factories unable to ship finished products. Back then, analysts blamed logistics. Later, it became clear the system was simply too optimized to absorb synchronized demand shocks. In my view, silver is entering a similar phase, not because demand exploded overnight, but because usage per unit keeps creeping higher. AI servers, power inverters, and grid upgrades all prioritize efficiency, and silver remains one of the few materials that consistently delivers it. That makes substitution harder than many models assume, especially when performance losses cascade through entire systems. Executives don't like admitting material constraints, but you can hear it indirectly when they talk about engineering trade-offs and input optimization. Those phrases usually mean engineers are being asked to do more with the same materials, not because it's cheaper, but because supply is tight. Another overlooked factor is geography. Silver demand growth is concentrated in regions building AI and energy infrastructure simultaneously. When multiple regions scale at once, global supply buffers vanish faster than historical averages suggest. In my view, this is why regional pricing differences are becoming more relevant than global spot prices. Shanghai, London, and New York don't always reflect the same urgency, and that divergence is itself a signal. Markets prefer one reference price, but physical systems operate locally, based on contracts, logistics, and trust. Trust is the fragile part. Once buyers worry about delivery reliability, they change behavior long before prices force them to. That behavior includes stockpiling, longer contracts, and accepting higher costs to avoid uncertainty. Those actions reduce available liquidity for everyone else, even if total supply hasn't changed much. This is how tightness forms quietly, without dramatic headlines or visible shortages. In my view, this is also why silver narratives lag lithium or copper, even though silver plays a more embedded role. It's not branded as strategic yet, but functionally it already is. Governments don't need to announce strategic importance for procurement rules to reflect it. Once public infrastructure projects specify certain performance standards, material demand becomes locked in by default. AI accelerates this process because it raises baseline expectations for power efficiency and reliability across sectors. What used to be optional upgrades become mandatory just to stay competitive. That ratchet effect is subtle but powerful. Standards rise, demand rises, and supply has to chase from behind. Historically, when standards move faster than extraction and refining, prices eventually follow, but only after friction builds. We're still in the friction-building stage, where everything technically works, just less smoothly than before. Those are the moments markets tend to underestimate most. They look stable, rational, and boring, until suddenly they aren't. In my view, silver is sitting in that uncomfortable middle ground right now. Not scarce enough to panic, not abundant enough to ignore. That's often where the most consequential repricing begins. Not with excitement, but with quiet discomfort spreading through procurement desks and engineering meetings. By the time that discomfort reaches traders, the easy explanations are already gone. And what's left is a market trying to catch up to decisions that were made months or years earlier. That's the phase we seem to be approaching, slowly and without much noise. Which is exactly why it's worth paying attention now, before attention becomes unavoidable. What adds tension here is that public optimism around AI hides how fragile its inputs really are once scale stops being theoretical and starts hitting procurement reality. In my view, when Elon Musk talks about AI needing radically more power, he's indirectly describing a surge in conductive demand most forecasts still underestimate. Power isn't abstract. It means transformers, inverters, connectors, and thermal systems, all of which quietly rely on silver to meet efficiency thresholds. What's interesting is that utilities and grid operators are already warning about upgrade backlogs, not because demand vanished, but because components are harder to source. Those warnings rarely make headlines, but they show up in regulatory filings and earnings calls if you listen carefully. In my view, grids are becoming the hidden transmission mechanism between AI hype and metal stress, and silver sits right in the middle of that bridge. AI doesn't just consume electricity, it reshapes where and how electricity is generated, stored, and transmitted. That reshaping forces upgrades that weren't planned a decade ago, and unplanned upgrades are always more material-intensive. The market still treats this as a future problem, but capital spending suggests it's already being priced internally by large operators. Data center builders are locking long-term energy contracts, not because power is cheap, but because availability is uncertain. When availability becomes uncertain, every input tied to that system inherits the same risk profile. In my view, silver is quietly inheriting that risk, even if it's not being labeled that way yet. This reminds me of how copper was ignored before the renewable buildout became unavoidable, then suddenly reclassified as strategic. The reclassification didn't start with prices, it started with procurement stress and missed timelines. We're seeing early versions of that stress now, just fragmented across industries instead of concentrated in one headline sector. Fragmentation delays recognition because no single buyer feels the full pressure yet. But fragmentation also means pressure accumulates system-wide, not locally. That's usually when markets misjudge turning points because they look for one big trigger instead of many small ones. Another factor is substitution limits. Silver isn't used because it's fashionable, it's used because it solves engineering problems cheaply and reliably. Replacing it often means accepting lower performance or higher energy loss, which compounds costs at scale. When AI workloads already push power limits, performance loss isn't a small trade-off, it's a bottleneck. In my view, that's why silver demand is less price-sensitive in these applications than traditional models assume. Companies won't redesign entire systems to save marginal input costs if it risks reliability or regulatory compliance. That rigidity is rarely captured in commodity forecasts, which assume flexible substitution that doesn't exist in practice. You can hear this tension when executives talk about engineering constraints instead of input costs. That language shift usually happens before markets update their assumptions. Another subtle signal is how defense and public sector AI projects are being prioritized regardless of cost efficiency. Once governments embed AI into security, surveillance, and logistics, demand becomes politically protected. Protected demand behaves differently. It doesn't disappear during slowdowns, and it doesn't respond cleanly to price signals. In my view, that makes silver exposure more structural than cyclical in this context. This doesn't mean prices must surge tomorrow. It means the downside assumptions people rely on may be weaker than expected. Markets often assume that if growth slows, demand will ease naturally. But strategic demand doesn't ease, it shifts budgets. When that happens, civilian markets end up competing with projects that don't have profit constraints. That competition changes who sets the marginal price, even if it's invisible at first. We saw this dynamic in energy during geopolitical shocks, when governments outbid commercial users quietly. Silver could experience a softer version of that, spread over years instead of months. In my view, that slow grind is harder for markets to process than a sharp spike. Sharp spikes trigger reactions. Slow constraints trigger complacency. Complacency is dangerous because it allows assumptions to harden just as reality drifts away from them. That's why this story feels unresolved rather than dramatic. Nothing looks broken yet, but the system feels tighter in ways that don't show up cleanly in charts. Those are the environments where mispricing tends to persist longest. And when it finally corrects, people usually argue that the signs were obvious all along. In hindsight, they often were. They were just boring, technical, and spread across too many industries to feel urgent. AI changes that by synchronizing demand growth across sectors that used to move independently. Synchronization is what turns manageable stress into systemic pressure. In my view, that's the real risk signal behind the silver discussion. Not scarcity, not hype, but synchronization. When many large systems move together, the margin for error disappears quietly. That's where we seem to be heading, step by step, without any single announcement marking the shift. And historically, those are the moments that matter most, even if they're the least exciting to watch in real. What complicates the future is that silver demand isn't rising in one place. It's rising everywhere AI touches infrastructure at the same time. In my view, this is why traditional supply forecasts keep missing the picture, because they assume demand waves stay isolated and sequential. AI breaks that assumption by pulling power upgrades, automation, data centers, and grids forward into the same narrow window. When timelines compress like that, supply doesn't need to fail completely to cause stress, it only needs to lag slightly. Those small lags are enough to change behavior, especially for buyers who can't afford delays. We're already seeing procurement teams prioritize certainty over cost, which historically precedes tighter physical markets. That behavior doesn't show up in futures curves, but it reshapes how material moves behind the scenes. In my view, the future risk for silver isn't a dramatic shortage headline, it's a gradual loss of flexibility. Once flexibility disappears, every unexpected shock becomes harder to absorb. Another future path people ignore is regulation. Efficiency standards keep rising, and silver is often the easiest way to meet them. When standards rise, demand becomes embedded, not optional. That embedding makes future demand less sensitive to economic slowdowns than most expect. At the same time, new supply faces environmental, permitting, and capital hurdles that didn't exist decades ago. Those hurdles slow response time, even if prices eventually justify new projects. In my view, that time gap is where volatility tends to emerge, not at the moment demand is announced. The market usually realizes constraints exist only after lead times stretch beyond acceptable limits. By then, behavior has already changed, and reversing it becomes difficult. Another future outcome is geographic fragmentation, where regional silver markets behave differently. We're already seeing early signs of this through premiums and delivery terms, even if spot prices look unified. Fragmentation reduces the usefulness of a single reference price, which adds uncertainty for planners. Uncertainty pushes buyers toward longer contracts and inventory buffers, further tightening availability. This creates a feedback loop that doesn't require panic to sustain itself. In my view, that loop is more likely than a sudden spike, because it aligns with how institutions actually behave. Institutions rarely panic, they quietly over-prepare. Over-preparation looks inefficient until it becomes the new normal. We've watched this pattern repeat in energy, shipping, and even labor markets over the past decade. Silver now sits in the path of that same institutional logic driven by AI's scale. The future question isn't whether silver is essential, that's already settled. The question is whether markets adjust early or wait for stress to force recognition. Historically, they wait. Waiting doesn't mean nothing happens, it means adjustments happen unevenly and without consensus. That's when narratives fracture, analysts disagree, and volatility increases. In my view, that's the phase silver is moving toward, not explosive, but unstable in subtle ways. Subtle instability is harder to hedge, harder to explain, and harder to ignore once it spreads. This doesn't point to a single outcome, but it narrows the range of comfortable assumptions. Comfortable assumptions are what markets rely on most. When those erode, behavior changes long before prices do. That's why watching how systems prepare matters more than watching what they say. Right now, systems are preparing for a world where AI growth is constrained by physics, not imagination. Silver is one of the materials sitting closest to that constraint. Whether markets acknowledge it early or late will shape how disruptive the adjustment feels. And in my view, the longer recognition takes, the less smooth that adjustment usually becomes. Not because anyone is wrong, but because reality doesn't wait for consensus. It moves at its own pace, quietly, until it no longer can. The real ending of this story isn't about a sudden spike or collapse. It's about how systems behave once they accept that growth is no longer frictionless or abstract. In my view, the most important shift is psychological. Leaders in AI now speak as if physical limits are structural, not temporary hurdles innovation will magically remove. Once that mindset settles in, planning changes everywhere, from capital budgets and procurement rules to how infrastructure is designed for decades ahead. Silver sits inside this shift not because it is rare, but because it solves efficiency problems that scale-driven systems cannot easily substitute away. The future path I see isn't dramatic scarcity, but persistent tension between synchronized demand and supply chains that move slower by design. That tension doesn't break markets overnight. It bends them gradually, creating small distortions that compound quietly across time. Those distortions appear first in behavior, not charts, as buyers prioritize certainty, redundancy, and guaranteed access over marginal cost savings. Historically, when markets enter this phase, spot prices lose importance compared to contracts, delivery guarantees, and regional availability. That's when debates intensify, because observers argue using prices while institutions act using logistics and risk models. In my view, silver is moving toward that exact phase where multiple realities exist at once, depending on who you ask and where they operate. Some participants will point to inventories and say nothing is wrong, while others quietly struggle to source material on reliable timelines. Both perspectives can be correct at the same time, which makes consensus almost impossible during transition periods like this. Confusion isn't a market failure. It's a signal that old frameworks still function, but no longer explain outcomes consistently. AI accelerates this confusion because it compresses timelines and forces many sectors to scale simultaneously instead of sequentially. When grids, data centers, automation, and defense systems all expand together, small inefficiencies stop being small very quickly. They cascade through logistics, procurement, and engineering decisions in ways no single price chart can capture. In my view, this is why the silver conversation keeps resurfacing without resolution or closure. The system is signaling stress, but not enough to force a clean narrative that everyone agrees on. Those moments are the hardest to read because they require patience rather than conviction or bold predictions. Looking forward, the most likely outcome isn't clarity, but adaptation across institutions and markets. Markets adapt by widening acceptable ranges, institutions adapt by locking supply early, and narratives adapt slowly and unevenly. By the time a new consensus forms, the underlying structure is usually already fixed by sunk costs and long-term commitments. This is how previous transitions played out in energy, shipping, and global finance over the past decades. Silver now appears to be entering a similar chapter, driven not by fear or speculation, but by scale and coordination. Scale exposes assumptions that worked when demand was smaller, slower, and less synchronized across industries. Once those assumptions break, rebuilding them takes years, not headlines or short-term price moves. In my view, that's the real warning embedded in the AI and silver discussion. Not that something dramatic must happen, but that flexibility is quietly disappearing from the system. When flexibility fades, systems become more sensitive to shocks, even relatively minor ones. That sensitivity doesn't guarantee disruption, but it raises the cost of being wrong. Markets dislike being wrong more than they dislike being slow, so adjustments tend to come cautiously and unevenly. This story doesn't end with a number, a forecast, or a call to action. It ends with a change in how growth itself is understood. AI growth is no longer just about ambition and software, it is about physical tolerance and material limits. Silver happens to sit exactly where that tolerance is tested. Whether attention arrives early or late won't change that role. It will only change how smooth or uncomfortable the adjustment feels when it finally becomes obvious. And historically, the smoothest adjustments are the ones people only recognize after they are already complete.